Good evening. We want to welcome everybody to our Cattle Edge Producer Education webinar that we're hosting this evening. My name is Benita Lettier. I'm Director of Producer Education with the Nebraska Cattlemen. We are excited to be hosting our Cattle Edge webinar this evening with our partner Fnbo. Nebraska Cattlemen works for cattlemen on issues affecting them. If you are not a Nebraska Cattleman member, we hope that you will consider investing in our organization. We need you to help keep us growing strong. We have several affiliates that have scheduled events in the next month, so make sure you check out our Nebraska Cattleman website for more information. A little housekeeping for our webinar this evening. If you have questions for our speaker tonight, please use the Q&A box at the bottom of your screen. Chris will be watching for questions and will be getting them to Kurt to answer. You can ask your questions throughout the presentation. We will go live with questions at the end of Kurt's presentation, and we'll give you some further instructions on that when we get to that point. If you have any questions, please call me or text me at 402-450-0223. We are recording the webinar, and we will be posting it on our website. Our presenter this evening is Kurt Spieler. Kurt is a Chief Investment Officer responsible for developing and implementing investment strategies for the Wealth Management Division at Fnbo. Kurt joined First National Bank in 2005 and has over 30 years of experience in portfolio management. Our moderator tonight is Chris Kowkowski, and many of you will recognize Chris. He is a very active member with the Nebraska Cattlemen, and you've seen him at several meetings. He works in the Omaha office. So I'm going to turn our webinar over to Kurt and Chris, and we will get started. Our presentation will run roughly around 35 minutes tonight. And then, like I said, make sure you get your questions answered throughout, and we will go live with questions at the end.
Good evening, everyone, and welcome. And we have the joy tonight of having Fnbo's Chief Investment Officer. A little different schedule for us, those of us that work in agriculture every day. We're bringing someone in that is not directly involved in agriculture, but I think you will find him very interesting. You've seen him or may have seen him on CNBC. He's been with the bank since 2005 and has over 30 years of experience in portfolio management. So our goal tonight is to bring a little different perspective to your day. So often we spend our days working in our businesses, and sometimes we need to take a little bit of time to work on our business. And hopefully tonight will give you a little bit of perspective to chew on and think about. I hope you walk away with something to aid you in your business and that you enjoy. We'll do our best to get your questions in the next hour. Please don't hesitate to add them in. I think Kurt will enjoy being interrupted to make sure the conversation goes where it adds value to you. So with that, Kurt, do you want to take it away?
Yes, thanks, Chris and Benita for the introduction. As I was putting together the presentation, I thought the focus would be on inflation, what's causing it, will it moderate? And then recession, are we already in one, as was recently reported, 2 negative quarters of GDP growth, or alternatively, will we head into a recession over the next 12 months? As I was looking at this landscape here, in terms of economic environment, I found a lot of challenges that we're facing. So what I characterized as macro headwinds, starting with inflation, and then it permeates through Federal Reserve monetary policy, the U.S. government's fiscal policy, consumer demand, and how individuals are facing, and on down the list. So there's a lot of challenges facing the economy, really starting with inflation. On the positive side, there are some macro tailwinds, some positives regarding the financial situation of both consumers as well as businesses, and then the employment market. But as we alluded to earlier, when I put this presentation, it's a guess in terms of what you may want to hear. So I would echo the comments, use the Q&A function. If I talk for 35 minutes without questions, I'm going to consider this a fail, primarily because I'll probably bore you going through economic slide after economic slide. So we understand that it's more difficult within a Zoom meeting as compared to in person to get that conversation flowing, but I also wanted to add that encouragement. Starting on the negative side with the macro headwinds, if you look at it, inflation is running about 9% if you use the consumer price index. Other measures, whether it's the producer price index, personal consumption expenditures, all show an elevated inflation. There's a number of factors that's creating that environment. From our perspective, one of them is liquidity, and we're defining liquidity through M2, which is cash, checking deposits, and easily convertible near money. And so the green line here on this chart over the last 15 years is inflation. You can see it spiking up. The left axis would be in that 8.5%, 9% range. And then M2 is defined by money supply, is showing the rapid increase there in 2019 and 2020 and into 2021 from that perspective. If you look at it, the three highest periods of money supply were the late 1970s, the early 1980s, as in 1981, and then the last couple of years. And so we think this excess liquidity that came about for a number of reasons, zero interest rates from the Federal Reserve, additional stimulus checks from the federal government, additional savings for a period of time there from U.S. consumers. On the positive side, M2 has fallen quite significantly this year and is running around 6% currently. So at some point that this excess liquidity is getting out of the monetary system will help in terms of the fight against inflation. The Federal Reserve, if you look at the next chart, and this is monetary policy and what they characterize as the dot plot. So what's expected in terms of Fed funds rate increases. What we found, I guess, somewhat amusing is back in December, the Federal Reserve is expecting 75 basis point increase in interest rates for the full year. And that's the lower left green bar from that standpoint. So they were still characterizing inflation as transitory and thinking some slight increases of interest rates. They've significantly changed that view as this year progressed. In fact, they did 75 basis points in June and then 75 basis points again in July alone in those months. And you're now expecting by year end for the Fed funds rate to be up another 1% from here in that 3.25% to 3.5% range. So the reason why the Federal Reserve is taking this approach is to reduce demand for goods. And so they're trying to reduce inflation. It's the only tool they have by slowing down the economy, in particular, the consumption of goods as well as services to a lesser extent. In terms of their track record in getting it right, they've gone through 14 times here over decades, many decades, in terms of increasing interest rates to slow down and decrease inflation. They've done it 3 times without causing a recession. So for those of you that are baseball fans, 3 out of 14 is not a great track record by the Federal Reserve. Now, they have been more successful in bringing down inflation, but at times it has caused a recession. Turning to the fiscal policy, which certainly contributed to the excess inflation. This is the federal government budget deficit. You can see in 2020 and 2021, $3 trillion of deficit spending each year. So this was the additional stimulus checks, childcare, unemployment extensions, across the board. You have seen this come down here in 2022 and 23. This is the U.S. Office of Management and Budget Expectations. And so less deficit spending, I guess if you call it, still spending in excess of $1 trillion. Better, I guess, stewards of our tax money. This, by the way, is before the Chips and Service Act. That's not policy or law, so there hasn't been an adjustment to budget deficits, as well as perhaps the most misnamed Budget Act, the Inflation Reduction Act. that is also not been authorized or approved or gotten through Senate from that standpoint. So it's still out there in terms of what is the level of spending by our federal government. On the surface, though, spending less has an impact on economic growth in terms of slowing it down, and also would help with the moderation of inflation.
A quick question for you, Kurt. You made a comment about the Inflation Reduction Act. Can you explain how that act is even being seen to reduce inflation?
I don't think it is. I think what you've seen from other economists is that it's probably not additive to inflation. So some of the features of it, increasing the corporate tax, is related to deficit reduction from that standpoint. Some of it is investment, obviously, in clean energy from that standpoint. So if you look at the various features, it's not, the intention is, perhaps to reduce inflation, but we don't think it's going to go down that path. It's likely not additive to inflation. So it's not like maybe the deficit spending that we see here or did experience here in 2020 and 2021. So because of some of the features, the revenue increases, the deficit reduction, as well as the additional spending, it's probably more net neutral. But I think it's, politically named, in front of midterm elections. But at least I guess the positive would be is it's not expected by most economists to be added to inflation. Good question. Please keep them coming. The other aspect, going to the third headwind, would be consumer demand. And this, in our view, is always tied closely to compensation. So do people have jobs? How much income are they generating, from their level of employment? And what this shows is the employment cost index. So wages are going up about 5% here in the U.S. So on the surface, that's good news, compared to the 2 to 3% that we've been running for much of the last 15 years. The bad news is if you look at it on a real compensation level, so in essence, subtracting out inflation from that 5% increase, you can see real wages are about negative 3%. And so that's a factor in the economy. If you look back at it historically, even longer than the 15 years, when you have real disposable income, so in essence, what people have to spend after essential items, so, after going to the grocery store, energy or oil, going to the gas station, so discretionary spending income, it's pretty closely correlated with a slowdown. And so it's not a surprise that we're seeing slower economic growth, slower consumption as this year progressed, just because many individuals, especially in the lower income levels, have less money to spend. So they have less discretionary income. So this is creating already a slowing consumption, although consumption in the first quarter was around 1.8% growth. In the second quarter, it's about 1%. So you're still seeing consumption, but it's much less than expected. And from our perspective, people just have less discretionary income to spend. The other aspect of consumer demand is, oh, you have a question, Chris?
I was trying to find my mute button. I'm sorry, Kurt. We had a question that comes in on slide 6 before this on the budget deficit. There you go. What did the budget deficit look like the past 2 decades before this slide?
Yeah, a great question. It's varied. If you look at the last 2 decades, on occasion we've ran close to zero or a small surplus. But in general, I would say the deficit average over that, let's say, 20-year period is probably closer to the 400 billion range. And so the deficits, even in 2017 and 2018 and 2019, were growing primarily because of the tax reductions that then President Trump and the Republican Congress implemented. So that did cause an increase to go above the 500 billion towards $1 trillion there in 2019. So we definitely have been running. There have been periods of time in the U.S. in that we've run deficits. Part of this is, $1 trillion. It's hard to believe that we're talking about that amount of money, but as the size of the economy has grown, that impact is less. It's more equivalent, 20 or 30 years ago to a $500 billion deficit. So certainly, how we've characterized the persistent government deficit is, there's going to be a cost associated with that. Unfortunately, the U.S. economy and overall debt levels are not at a degree that it's creating a financial crisis. So our debt levels compared to Japan, most of Europe, United Kingdom are still less from that perspective. And so that's kind of allowed it. The markets accepted these high deficit. And so we're in essence pushing the can down the road in terms of the problem that all this deficit spending is going, it's going to come to fruition at some point, but likely not today. Going back to the consumer just briefly here, consumer demand, this is the Consumer Confidence Index. It's broken out into their two factors of how to, in essence, what is the confidence levels for the present situation, what's going on now in everyone's life. That's the blue line, which is shown at a little bit higher level and I think that's related to the strong job market, income growth. It has started to come down. The latest number came out last week. It's not on this chart, but it's a third monthly decline for the present situation. But the other story is expectations. So because of high inflation, changes in government policy, the geopolitical environment with Russia and Ukraine, the expectations have fallen to levels that we haven't seen since 2013. And so that's the orange line saying people's expectations. Although there's not a direct cause and effect between confidence and spending, there is, ultimately an impact. You're starting to see that in surveys. So people are expecting less people at least are expecting to buy a house, buy an auto, major household appliances are actually, people are expected to spend less. And so it does ultimately have an impact on consumption, especially if that negativity continues. So we've focused a little bit on the demand side, what the Federal Reserve is doing, what the government's doing, how consumers are positioned. One of the other aspects that's led to inflation, though, is the supply of goods. China and their zero COVID policy, they have gotten manufacturing back online. Imports from China have, in essence, increased here over the last month or two since the restarting of facilities. But this was an aspect of what created inflation was you had all this excess liquidity and demand for goods, and you didn't have the supply of goods. So due to the pandemic, you just saw a lack of supply. We saw that, with some of the stories coming out in terms of the ports. How companies are doing to respond to that, interestingly enough, it's not carrying a higher inventory level. Although, if you're talking to an apparel company right now, they're running too much inventories, and that's been a piece of the negative growth here in the first half of the year. So there are no plans to change that, to change from that just-in-time inventory, but they are looking at broadening the supplier base, investing in various areas, the supply chain, localizing the supply chain, accelerating productivity investment, as well as within physical assets. So companies are responding to this supply of goods problem by increasing supply. So the good news is that it will help. So you're starting to see that in some sectors, although other industries are experiencing difficulty. The bad news is it takes time. So some of these capital investments, they're looking at a payoff down, a year, 2, 3, 5 years down the road. So this is kind of long-term solutions to a short-term situation that's added to the inflation story. Pivoting a little bit from that demand and supply argument, commodity prices are a piece of the story, and this shows the last 5 years in terms of what commodity prices. This is the GSCI Commodity Index. It is energy tilted. Energy is about 41%, combining WTI and Brent crude oil for that. It also has natural gas, agriculture. There's some 24 different commodities. It's also a little bit misleading. If you look up here on the upper right, you see June was a decline. Some commodities actually peaked out in March, and some was closer to the June 8th timeframe. But July commodity prices have rolled over by about 10% in aggregate. So you're starting to see some relief in commodities, although this index is still up 18% year to date. It's not up 36%, which it was at one point there in the March timeframe. So this has been, part of the story, especially I would say the energy market. So this is the 12-month consumer price index for energy, the price change, and you can see here recently we've been in the 25 to 30% to actually almost reaching 40% there in June. And the reason why I pointed that out is, I think oil has such an impact here on the U.S. Economy. It's part of the story that I shared earlier about less discretionary income if you're spending more at the grocery store as well as at the gas station. So it has a tendency to flow through into inflation in other areas. It also has the tendency to have occurred in terms of spike in energy prices when we've had recession. So you can see that a little bit. The gray areas is the recessions there in the financial crisis in 2008 and 2009, as well as the one quarter reception there in May 20. You didn't see the spike there from the COVID-19 downturn. But if you go back into the 70s and 80s, you also see that correlation with inflation. The other impact, in addition to commodities, that's seen a lot of price appreciation is the housing market. I'm sure if you own your home or you're trying to buy a home, you've seen that in terms of the supply and demand for imbalance that we've seen within the housing market. And this is housing starts in the teal line in the Midwest. Here you had seen it start to creep up here over the last year or two in response to higher prices and strong demand, but you've already seen the last couple of months that it's rolled over quite a bit. The yellow line, we probably could have come up with a better chart for you, but it shows the last year, the 20% price escalation in median home prices. Actually, if you go back in many markets, you've almost had back-to-back 20% price increases. And so one of the results of the Federal Reserve monetary policy, the zero interest rates, the buying of treasuries and mortgage-backed securities last year was you created too much demand in housing. That, as I mentioned, is already starting to change. So if you look at it, a big piece of that starting to change is higher interest rates. So this is the 30-year mortgage rate over the last 3 years, approximately 2.5 years. If you looked at it, we were running sub 3%. Hopefully you refinanced during that time frame. If you look at it, mortgage rates went from 3 to 4%. The market said, that's fine. Affordability is not a problem. Mortgage rates went from 4 to 5%. Pretty similar response. You're still seeing price appreciation at that time. The market went above 5%, and that's where affordability became a problem. So we're now at 15-year lows in affordability with prices up, with mortgage rates now here last week reported at 5.3% in aggregate. So you're starting to see that impact of inflation on higher interest rates and that impact on Fed policy. Housing, one of the most interest rate sensitive sectors here in the US, you're starting to see that impact there. Go ahead.
So we've seen the impact of the housing slowdown because of increasing interest rates. But can the Fed affect the rest of the economy by raising interest rates? In other words, can they slow inflation by increasing interest rates with so much money in the system?
I think they'll have limited effectiveness in slowing economic growth from those higher interest rates that they're doing. You'll have an impact potentially within the auto sector, another interest rate sensitive sector, in addition to housing. So there's certain industries that will be impacted. One of the things that I should have mentioned in the Fed funds chart page, and I'll go back to that if I can do that pretty quickly. So this was the dot plot. That's not the only tool that they're using. So they've announced what's called quantitative tightening. So I kind of mentioned that additional treasuries and mortgage-backed securities that they were buying last year, increasing the size of the Federal Reserve balance sheet. In June, they started to reduce it by $47.5 billion a month. And in September, it's supposed to decrease the Fed's balance sheet, which is now $9 trillion now, by $95 billion a month. And I think the quantitative tightening has kind of been underreported by the media. Will have more of a direct impact on money supply, or M2, and taking liquidity out of the U.S. economy. And so I think actually that part of their monetary policy tightening will prove to be more effective in terms of reducing inflation.
So on that note, there are those that are talking about, as the Fed tries to decrease their balance sheet, so to speak, that has got to be purchased back by the market, and that since they were booked at a lower interest rate, that the market's not going to be willing to buy it back at where the Fed wants to, and that's going to create a large drag on the economy. What's your thoughts on that?
Yeah, I don't know if that will have as big of an impact, or at least it certainly hasn't so far. So if you look at this, quantitative tightening was announced in early May, started in early June, albeit at a fairly small level and primarily related to maturities. Interest rates there in mid-June, the 10-year was 3.4%. The 10-year today is 2.75, and so it's not all related. Some of the paper that they're reducing is 1, 3, 5 year type paper, and so that's part of the story. But I think the market will ultimately set the interest rates. I think I would characterize it as, I'm surprised by the bond rally over the last 2 months, but it's really related to recession fears. So the economy is going to slow. The Fed's not going to get it right from that standpoint. So ultimately, I think the market, which is economic growth, inflation, will be more of a factor than the Fed getting out of it. But it is a change. So you could articulate that the Fed has been influencing and keeping interest rates lower than expected. So maybe this will result in a higher interest rate environment and ultimately have the impact that you thought, Chris. But to date, the opposite's happened in terms of, and the same thing happened when they were reducing their balance sheet back there in the mid 2015, 2016 range. We did actually see interest rates come down and not go up in that environment. And that's just because the economy couldn't stand on its own and there were a lot of recession fears. Switching a little bit to businesses and where do they stand. This chart shows corporate profitability since 2014. In essence, the end of last year, companies were more profitable than ever here in the U.S. This does show the benefits of the tax reduction in 2016 and 2017, but then the strong downturn and rebound during the COVID environment. So companies are at an all-time high from that standpoint. There is some cracks in this armor a little bit in that you're starting to see earnings growth less than what we've seen over much of the last few quarters. And this chart shows the U.S. quarterly earnings. This is the S&P 1500, the year-on-year change. You could see it running quite strongly when the economy recovered post the COVID-19 downturn there in Q2 of 2020, and then you've seen the explosive growth since then. For this quarter here in the second quarter right now, we're running around 2% earning or 6% earnings growth for the second quarter, and expectations right now are for 8 to 9% growth the rest of the year. We would be in the camp of being somewhat skeptical about that earnings outlook. you know, and there's risk associated with it as if inflation comes down as well as the economy stagnates, can you get even in the 6% growth that's expected here in the second quarter? Lastly, here on the negative side, inflation expectations. This is the University of Michigan 12-month. We kind of picked one in the middle of the road that the average person here that was surveyed expects around 5.3% inflation over the next 12 months. Consumer confidence index would show higher inflation. You could see the Treasury inflation protection and securities market, or TIPS market, would show more like 2.5% to 3% inflation. And the reason why this is a risk is if inflation becomes embedded in the economy, then it kind of becomes persistent or continuous from it alone. So if you have those higher expectations, and this is something certainly the Federal Reserve is watching closely, because it's not only about current inflation, but what people expect, because that has an impact in terms of income or wage expectations and other areas in terms of that spending pattern.
So as you wrap up kind of the negative sides of things, Kurt, your opinion, do you believe that the U.S. will go into recession, or if we are already there?
I would say we're not in a recession today. If you look at it, it's the National Bureau of Economic Research that decides that, so it's not me that decides that. And if you look at the primary factors that they look at, it's industrial production, it's income, it's spending from that standpoint, and it's employment. So those are kind of the four factors, and all are slowing, but they're not negative at this point. And so the negative GDP prints, the quote technical recession, is related to inventory and exports. It's not those primary factors. Will we go into one, though? I think the odds have gone up quite a bit. So my probabilities over the next 12 months is right now around 60% likelihood of a recession. We're just seeing too many areas slowing, and I think inflation still is the key to that. So when we wrote the mid-year investment update that was published in July, and we can make it available, please contact us if you'd like to read our mid-year investment update, would say inflation needs to slow less than 4% fairly quickly to avoid a recession, and that's just not happening. So we think inflation will be a little more persistent, which makes avoiding a recession less than a 50-50 possibility in our view.
So while we're thinking about your opinions, if you were the inflation czar, what would you do to control inflation?
I would, they're doing some of the things, right? I would continue to focus more on M2 or money supply. Shrinking the balance sheet would be more of a focus than increasing interest rates. And then it comes down to the federal government and deficit spending from that standpoint. So we need both the Federal Reserve and the federal government to be more conscious that this excess liquidity is causing it. The one thing that I would say, and I do want to touch, you know, I know we're into 35 minutes here, the macro tailwinds, is that, you know, we've presented a fairly negative case for you today, a lot of headwinds or challenges facing the U.S. economy, but we are also in that the inflation, if it does occur, will be fairly mild by perspectives. And that's really based on the three tailwinds that we have. The first one is healthy consumer balance sheets. Household net worth has increased by 35% over the last 3 years. That's benefiting from home price appreciation in the stock market until the last 6 months, the excess stimulus checks. And so consumers are in really good shape from a net worth standpoint, a debt standpoint, interest costs, et cetera. The disposable income has not grown because of that higher inflation. So that's, as we mentioned earlier, a little bit of a drag, but overall, companies are individuals that have more financial strength. This chart kind of shows it. It's a little bit complicated. So the average savings rate is 7.5%. That's the yellow line. The blue line is the current savings rate. You can see it was quite a bit above 10% for much of the last 3 years, has dipped down to the 5% level. So people are, and that's that difference. So how are people spending more when their real income is negative 3%? Well, they're saving less, than they typically would. So they're spending some of those excess savings. But that's the key, and that's the red bar, is through all these factors, spending less, savings more, by mid and upper income individuals, by those stimulus checks, you have 2 trillion plus in excess savings than you otherwise typically would be in this scenario. So consumers are in pretty good shape. I would say businesses are as well. So all those high profits, record profits that I mentioned, what have they been doing that, over the last few years? They've been reducing debt. So the corporate debt to equity ratio has declined here significantly. It's basically at 15-year lows. So some of that profitability has resulted in less debt. Corporations have refinanced at those lower interest rates over the last couple of years. And so you're still seeing a pretty good environment from a corporate leverage standpoint. That's showing up in delinquencies. I think all banks, including Fnbo, excuse me, have reported that their delinquencies and defaults are at extremely low levels, whether it's individuals and credit cards, whether it's corporations and delinquency rates from that standpoint. So, you're just not seeing a lot of signs of financial stress. So this is the exact opposite of 2008 and 2009, where you had the housing bubble, you had individuals over leverage, you had businesses over leverage, and quite a significant and negative downturn that took years, if not a decade, to recover from. The green line in this chart is option adjusted spreads. So there, do companies still have access to capital in the credit markets? They do. You have started to see some signs of stress there within corporate spreads, but nowhere near where you typically see in a recession. So we would say the fixed income market is not experiencing or expecting a recession from credit spreads, although the negative yield curve, you're starting to see it priced in that the bond market is thinking that a recession is coming. Lastly, on the positive side, unemployment rate of 3.6%. The other reason why I mentioned the factors that the National Bureau of Economic Research is bringing in. One, we created 1.7 million jobs here in the first half of the year. That's not typical during a recession. This chart shows the job openings. Here as of June was 11.3 million. The number reported earlier this week was a little bit lower than 10.7 million, but you're still well above the 6 million in unemployed and available workers, some of which to return to the workforce, some of them have lost their jobs. So this is the largest gap between job openings and unemployment that we've seen, although it's starting to come down the last couple of months. And really what the Federal Reserve is trying to do is they want to bring down the green line, that's job openings. They don't really want to bring up the unemployment level, the blue line. So they're wanting to have these lines move together, have more balance within the labor market between job openings as well as labor availability. The preference obviously is to keep the unemployment rate as low as possible, not cause a recession by having the blue line spike up towards the job openings line.
Okay, before we move into your next section, we've got some interest in the recession discussion. And so question is based on history, what is history telling us in regard to our current downturn trend as to when or if we start a recession? So I think they're focusing on the history and when, based on that history, we would see recession.
Yeah, it's a pretty wide range, surprisingly enough. And, there's a lot of factors that people use. And by a wide range, I'd say anywhere from 3 months to 2 years, is kind of the range that we're talking about. A lot of people look at the Treasury yield curve going negative. It's negative with the 2-year interest rate being above the 10-year interest rate. If the Federal Reserve continues to increase interest rates, the Fed funds rate will also be above the 10-year. That is an indicator that's usually 12 to 18 months, for example. So, there's no, really rule of thumb. The average is probably 12 to 18 months, but you have a lot of potential that it could be shorter. We could be already in a recession. We could be starting that right now to out a couple of years, but it's not typically as immediate as what economic forecasters would expect. I think from our view, I think we were always looking at, when we wrote our annual outlook, which we write in January for 2022, we thought the risk of recession was the first quarter of 2023. That may have been moved up a little bit in terms of towards the tail end of this year if it occurs, just because of how much inflation has stayed high and how aggressive the increase in interest rates and how that's impacting housing and other interest rate sectors. So, you know, if anything, we've become a little bit more cautious as this year has progressed from that possibility. Well, being an investment guy, I thought I'd leave you with just a few charts from an investment perspective. So the worst inflation in 40 years has created the worst first half of the year in 50 years in the stock market. And so certainly not immune to that. I thought we'd put it into perspective, though, by showing you bear market declines, and that's the Wall Street terminology for a 20% price decline. Without recessions, they occur, you know, fairly often, surprisingly enough. The average downturn in the green is negative 23%, and that's what we got between January 3rd and June 16th was a 23% plus price decline there in the S&P 500 in this case. So pretty much a typical bear market without a recession. With recessions, though, the average decline is 35%. So that's the risk. And the reason, if you think about it, is that without recessions, the earnings is still fine. We're still growing earnings, although a little bit less growth as we reported, you know, from corporate profitability. But the devaluation of the market, you know, based on higher macroeconomic risk has occurred. And so it's no longer a valuation story for the stock market. It's an E story. So what is earnings? In a recession, earnings typically fall by 10 to 20% based on the financial strength of companies. Maybe it's a little bit less this time if the recession is as mild as we expected. But that's the additional down leg, is instead of growing earnings by, you know, 5 to 10%, you see 10% plus earnings decline, and that's the additional down leg in the stock market. So we're not on the word. So having said that, would you say, well, should we sell right now? Not from our perspective. So if you look at it, you're much better off being a contrarian. And when the news flow is the worst, when everyone's concerned about a recession or whatever, geopolitical risk or whatever is going on, that you're better off buying in the face of that negative news. So what this shows is the return buying when the bear or when the stock market enters a bear market. So this would have been June 16th when we saw that decline, when you busted through that 20% decline. That history would say you're better off buying. It doesn't mean that you won't go down lower. We may not have seen the lows there back in June, especially if we do get into recession and earnings decline, but you're still better off taking that long-term approach and staying invested even when the news flow is the bad. So it's the power of staying invested through market and economic cycles that, in our view, you're better off than trying to time the market, trying to say, well, I'm pretty negative now, so even though the market's down, I'm going to get out and be, you know, smart enough to buy in if, in fact, the market goes down further. If the stock market's not your thing, there's a little bit of good news in the fixed income side of the market, and that's we're no longer in that 1 to 2% or zero interest rate environment. So this shows the bond yields by sector as of June 30th. From treasuries, Barclays Ag is a combination of corporate bonds and treasuries, mortgage-backed securities, asset-backed securities, investment-grade corporate. This is municipal bonds, tax equivalent yields. So we put in a high tax bracket to show what those yields are. And in some cases, we've seen more than a doubling of yields. So it is a more interesting environment. They're still negative, you know, in terms of bond yields relative to inflation, so the real yields. are negative, but certainly more positive than where we were for much of the last few years during this interest rate environment. So more interesting. How this flow throughs for us within our financial planning is we look at the valuations of both the stock and bond market and make our planning assumptions. In this case, in July, we increased them because bond yields were up higher. Stock market was cheaper on a valuation basis. So the more stuff goes down now, the better your 10-year returns are going forward. That's assuming that you stay invested during that time frame.
So you talked a little bit about stock investing, a little bit in bond investing. Most of the people on the call are investing in cattle. Would you compare investing in the cattle business to investing in the stock market for us?
I think there's more similarities than you would think. I would assume, or I'll make this assumption about the cattle business, that your long-term investors, you've seen many market cycles, downturns, better pricing, what you're seeing today in terms of price realization. But it's a very cyclical sector with many ups and downs. But I would think that the smart owners would continue to invest during the cycle and to understand, how to ride through the downturns and how to benefit or profit from the upturns. From our investment philosophy, it's very similar. So what I just mentioned is, we don't believe in market timing. If you think the stock market is a casino that you can put some chips in and you can pull the chips away, that's not going to work. It's not going to work in the cattle business. Not going to work in terms of investing in the stock market. So to us, I would think that there's more commonalities, assuming you take that long-term approach. A lot of there's commonality in the tenets of diversification, in terms of the business. So, not having all your eggs in one basket, kind of approach. So I think done right, I think investing in the stock market, it's really investing in businesses that you think will provide you with upside and return over multiple years. And that's how we look at it. So when people talk to me about what should be my stock market exposure, I say, what's your expected return? What's your time horizon? What's your distribution needs? Because you really have no business investing in the stock market if you don't have at least a 5 to 10 year time horizon. So who knows what's going to happen the next 5 to 10 months, but I think the stock market's going to appreciate and provide you with value over the next 5 to 10 years. Kind of the same thing with owning a business that who knows when the next cyclical downturn is, but I'm sure you're expecting to make more money over the next 5 to 10 years, just as you would as an equity investor.
Thank you. Do we have additional questions? I think we're down to the disclosure. Benita, if you want to work to the raise the hand function.
Yeah, so if you have a question that you would rather ask live to our team here, and Kurt, please raise your hand. Down at the bottom of the screen, you'll see a raise hand. I will unmute you so you can ask your question. Please feel free to do that. I know sometimes it's easier to ask your question live than type it. So if you have a question, please do that, and we will get you unmuted so you can ask your question.
And while we see if there's any questions, Kurt, I'll ask you one. If we go into recession, how do you see, or what do you think a recession, how will it affect the Midwest versus, let me back up. How will a recession affect the Midwest and agriculture if it happens?
Yeah, I would think we'd be a little bit less impacted from that perspective, being tied a little bit more to agriculture, different cycles there in terms of commodity prices, demand, supply, the long-term demand for food, for example, will still be there. So in general, the Midwest economies have had more defensive characteristics as compared to your heavily manufacturing economies that you see more in the Mid-East, East Coast, from that, in terms of looking at it from a regional perspective. So normally the Midwest is a little bit more, or impacted certainly by what's going on globally as well as in other parts of the U.S., but to a lesser extent, because of their industry exposure is less manufacturing overall than some areas.
Okay, don't be shy. If you have a question, raise your hand and we'll get you. If not, we will wrap it up. We will be sending out an email tomorrow with a link to our webinar. You will have some contact information on there to get a hold of Kurt through Molly and through, so then if there are no questions, I want to thank Kurt and Chris for being here tonight, and thank FNBO for being a great partner, providing our members with some great information tonight. I want to thank everybody for being here. Have a great evening.
And on behalf of FNBO, we thank everyone for joining, and we look forward to hearing from you soon.